Hello and welcome to a new episode of the MIC podcast. My name is Moritz Weber-Schön and today's guest, Robert Pickering, came to my attention because I read his book, Blue Blood, Cazenove in the Age of Global Banking, a business history and also personal account of his time working for the then most prestigious stockbroking firm in the city of London. Robert graduated from Oxford University in 1981 with a master's degree in law and then worked for Allen Overy for over 2 years. In 1985, he joined Cazenove, where he headed corporate finance from 1998 onwards and was appointed CEO of the firm in 2001. He led the transformation of the business and worked on the joint venture agreement between JP Morgan and Cazenove. Robert continued to serve as CEO of the newly formed joint venture JP Morgan Cazenove until 2008. After many other positions and advisory roles, he is currently chair of the board at Marex, a global financial service platform. Welcome, Robert. Great to have you on our podcast show.
Good morning. Thank you very much, and thank you very much for having me. It's great to be here.
Since probably not all of our German audience knows what Cazenove Co was, perhaps you could start by explaining what a corporate broker is, why Cazenove had such a special place in the financial service industry in the UK at the time you started your career there, and why the position of chairman of this institution was one of the most sought-after jobs in the city of London.
Yes, well, Cazenove was the leading stockbroking firm in the city of London, founded in 1823, so it had been around for quite a long time. But when I say stockbroking, when you think of stockbroking, generally you tend to think of people wearing braces, shouting into phones, buying and selling shares on behalf of institutions or private individuals. And we did do that. But what we specialized in was what was corporate broking, which is a uniquely British concept. And that involved representing companies in their relationships with the markets. So raising equity capital, large public takeovers. In fact, any move which required an understanding of how institutional shareholders would react. So to that extent, it was really more like an aspect of what we would now call investment banking than traditional stockbroking. The firm was easily the number one player in that business. And when I joined the firm in the mid-1980s, and really for most of the 80s and 90s, we acted for around half the FTSE 100 index. And we had more clients than our next two competitors combined. The other thing that made it special and unusual was that when the structure of the City of London changed in 1986, which was a process known as Big Bang, all the other broking firms sold out to a variety of UK and international banks. And Cazenove was the only one to remain independent. And that sort of increased the aura and mystique which surrounded the firm.
Yes, exactly. And let's delve a little bit deeper into the history of Cazenove and the book you wrote about it. So you titled your book about Cazenove Blue Blood, what already suggests that a certain aura and air of exclusivity was an essential part of the firm's identity and self-perception. So could you explain why you chose this title and maybe 2 or 3 anecdotes that give us a good sense of the firm's culture?
Sure. Well, blue blood in English refers to a kind of aristocratic heritage. And the firm was always referred to in the press as blue-blooded Cazenove. And there was a certain amount of truth in it, as the firm, when I joined in the 80s, was quite an old-style, predominantly family-owned business. The family ownership had become spread between a number of different families, but most of the partners there, or a lot of the partners, were second or third generation, and most of them had some prior family connection to the firm. Pretty much all the partners had been privately educated, and around 50% of the partners had been to Eton, which is, as you probably know, is our most prestigious private school. And the culture, that put quite an imprint on the culture of the firm, and also quite a number of the partners in those days hadn't been to university. Instead, they'd joined the army. So there was a kind of military element to the culture too. So there was quite a big emphasis, and again, I'm talking back in the 80s and maybe into the 90s, but there was quite a big emphasis on how you dressed. And I mean, these are trivial matters, but there was quite an urge to conform. Some partners, when I joined the firm, were still wearing old style stiff collars. It was certainly expected that you would wear lace-up shoes. I remember, I tell a story in the book about how when I'd been with the firm for a few months, I went in to work wearing a pair of slip-on Gucci loafers. And I had to go and see, as it happened that day, one of the senior partners of the firm, and I can't even remember what we were talking about, but I do remember that in our short conversation, nothing was said about my shoe, but he spent the entire conversation just looking at my shoes. And needless to say, I never wore them to the firm again. So this kind of thing, and the various, there were a variety of rituals to do with, the kind of wines and liqueurs which were served in the lunchrooms. You had functionaries walking around the office, going to see the partners on Fridays, asking them how much cash they wanted for the weekend, this kind of thing. So it was very much, in those days, an old style culture. But again, you have to set against that. It was a very successful business, and it's easy to sort of make fun of the firm's culture, but actually, as I say, it was a very successful business, and in that respect, a very modern firm as well.
So could you actually say that it was a little bit less academic than banking is today?
Absolutely. I wouldn't want to give the impression that the partners were uneducated, but a lot of them, as you say, quite a few of them had been to university and had been to Oxford or Cambridge or whatever. But compared with, for example, Allen Overy, where I had worked, where all the partners would have been graduates and the majority would have been Oxbridge graduates, quite a lot of the partners at Cazenove were not graduates. And that was really consistent with the financial services industry in the UK at the time, which was much less quantitative and much less focused on numbers and spreadsheets than the business subsequently became. It was much more about relationships, matching buyers and sellers, matching consumers of capital and providers of capital. And that, as I say, was all about relationships, really.
Yes, exactly. And you explain this focus on relationships perfectly on page 20 of your book by describing how David Mayhew, the long-standing public face of Cazenove, managed his client relationships. And I quote, David had an extraordinary talent for forging relationships with all the principal UK investors as well as the senior management of the firm's most important corporate clients. The ability to move seamlessly between the providers and consumers of capital while being trusted by both made him an unrivaled judge of whether a transaction could be executed in the marketplace and at what price. David was slim, elegant and charming, but he also had nerves of steel, a quality he demonstrated many times during the years I worked with him. End of quote. So is it safe to say that the key of Cazenove's success was its incredibly strong client relationships, and therefore what can one learn from the way bankers at Cazenove managed client relationships for one's own business or activities today?
Well, that's what you said is correct, and certainly, you can, as I just have, one can talk about some of the more superficial aspects of the firm's culture to do with what clothes people wore or what they drank at lunchtime. Yeah. But actually, the thing that was really important in those days, and the thing that really made an impression on me when I first joined the firm, was how seriously the firm took relationships of all kinds, both on the institutional side and on the corporate side, and we had a high net worth investment management side as well. And a lot of investment banking firms and merchant banks, as they were called in those days, would talk about, the fact that they would put the client's interests first. But in Cazenove's case, that was really true. And many a time I'd sat in meetings where a client wanted to do something and the partner in charge would basically tell them that it wasn't a good idea, or it wouldn't work, or they shouldn't be doing that, they should be doing something different. And in the short term, that kind of advice cost the firm money because, the image of investment bankers and corporate brokers is that they kind of try to push companies into doing transactions in order to generate fees. And if that was true at any other firm, it certainly wasn't true at Cazenove. And of course, from a business point of view, at Cazenove it worked because we had so many clients. So you could afford to take a long-term view about your relationships, because you could act for a client and give them advice over a long period of time which you didn't charge them for, knowing that sooner or later some kind of transaction would take place. So it was the number of clients we had was an essential underpinning of our business model.
Yes, and what would you say can one learn today from the way bankers at Cazenove managed their client relationships back then?
Well, I think you see echoes of it because basically, it's a slight oversimplification, but essentially what happened in subsequent years throughout the 90s and into the 2000s was the sort of productification of investment banking. So investment banking, and this was really to do, and we'll talk about this in a bit, I'm sure, this is to do with the advent of the Americans into the UK and into Europe in particular, and their investment banking culture. But essentially you went from a model which was based around relationships and retained relationships. So in other words, you had a client, and those relationships were often very, very long term. And it meant that once they were your client, you didn't have to pitch for business anymore. But it also meant that if they wanted you to do something, you had to be there for them. You couldn't say, no, I've got a more important client here, or I've got another transaction that might make me more money, therefore I'm not going to do this. So it was a very relationship-based business. But over time, as I say, that became more of an Americanized culture model really, where essentially you talk to everyone in the market and you're trying to sell as much product as you can. That's a slightly pejorative way of putting it, but that's the reality of it, whether it's mergers and acquisitions or equity capital markets or debt capital markets or derivatives or cash management or whatever it happens to be. Their model is that they have a very wide range of products. They try to have relationships with as many firms as they can and to sell as much as they can. And it's been very successful for them. But in terms of the old relationship style, you tend to see it more in the some of the larger boutiques that have grown up, the Centerviews and Green Hills and Evercores, these kinds of firms, which are generally staffed by refugees from big investment banks, and where they have they tend to have a longer term and more relationship based approach to the business. And apart from anything else, they don't have the range of products to offer. So that's the model that suits them and that works for them.
And did this Americanized model also change the way the bankers were incentivized?
Yeah, again, one of the key aspects of the culture at Cazenove was that the whole firm, everybody in the firm shared in the same profit pool. So I'm making up the numbers, but let's say 40% of the profit went to, it wouldn't have been as much as that, but some percentage of the profit went to the staff as a whole, and then obviously the partners got the rest. But basically what it meant was that the incentive structure led to cooperation, because individualistic or selfish behavior wasn't rewarded. It wasn't rewarded financially, and it wasn't rewarded in terms of internal kudos. So, if we did a big deal on the M&A side, then people who specialized in broking, or even research analysts on the institutional side, were delighted because they knew that would boost the firm-wide profit pool. And so it did lead to cooperative behavior, which I think was very positive. Whereas in what tended to happen later on was that you'd have departmental profit pools or even desk-based profit pools. So people were incentivized to maximize their own personal P&L. And, that probably in the short term led to, well, certainly it would have led to a more profit-oriented culture than we had at Cazenove. But as I say, it gets in the way of that collaborative behavior, which generally is what helps you put the client's interests first, because you're not thinking about your own personal interest.
Yeah, and you just mentioned M&A. So when you started at Cazenove, they didn't really do M&A. But after you returned from New York, you built and led a mergers and acquisitions department in London. So what challenges did you encounter in doing so? And to what extent did you succeed in creating a competitive M&A platform?
Yeah, well, we did manage to build a decent M&A business. I mean, we had always, as a corporate broker, been involved in large public takeovers, but we didn't tend to do the financial advice. That would be done by a merchant bank or investment bank, and we would be there in the marketplace. So, for example, we might build a stake in a target company over a period of time, or if you're trying to determine what price to bid for a company, then understanding the attitude of the shareholders in that company is very important. Similarly, if you're doing a very big transaction, you need to know what your own shareholders think of it and whether they're going to be prepared to support it. So we were always involved in that. What we didn't do was the lead financial advisory work, and we didn't tend to do sort of private M&A in the sense of negotiated sales and purchases of divisions. And I felt that, when I was quite young in the firm, I felt that was a missed opportunity for us, because we had very, very good corporate relationships. And it didn't seem to me that the investment banks or the merchant banks were any cleverer than we were. So I thought that this was an opportunity for us to broaden out what we did for our clients. Plus, at this point, a lot of the merchant banks in the UK were starting to try to get into our business of corporate broking and buying broking businesses. So I saw it as a good defensive move too. So I was asked to set that up, and I recruited a little team, and we did make progress. But in the larger, and we got sales of divisions and this kind of thing. And to start off with, it tended to be transactions that the big banks weren't really interested in doing because they were too small or whatever. But we built a track record, and but also in public takeovers where we did the financial advice too. But it would tended to be a sort of co-advisory model. In other words, we would be a co-financial advisor, and we would be credited with financial advice. So we'd get the league table position, but there was very often another bank alongside us, which was probably doing more of the really heavy lifting. That less so later on in the piece, but that was sort of how we built the M&A business. But really what it was about was two things. It was trying to change the perception of how your clients see you, because we were very much known as a broker. And so, it was, well, hang on, you're brokers, so why would we hire you to do M&A? So one of the things I did early on, particularly when I was running corporate finance, was try to persuade our people to stop calling themselves brokers and start calling themselves investment bankers, which was a cultural change internally as well, because that pushed a lot of our people out of their comfort zone. And to start with, they found that quite nerve-wracking, because they didn't necessarily have the confidence to think they could do this kind of work. So it was a process of changing perceptions internally, changing perceptions externally, and giving people the confidence that we could do this kind of work. And part of that was I recruited quite a lot of people who'd worked in investment banks and merchant banks to help give us that expertise and capacity to do these larger types of transactions.
And did you already offer the full range of products offered by a typical advisor at that time, or did you focus on specific products?
We didn't tend to think of it in those terms. I mean, the whole terminology of product is something which came in much later. We would have been horrified to think that we had a product. To us, it was all about relationships. But yeah, I mean, in reality, our product offering was very narrow. It was essentially equity capital markets, corporate broking, and M&A advisory, and a little bit of debt advisory. But we didn't really do anything else. So, and we'll come on and talk about that, but that was one of the reasons why we ultimately felt that we needed to find a partner, because we were in danger of becoming less relevant to our large corporate clients.
Finding a partner for Cazenove is exactly the chapter I would like to discuss now. So at page 96, you explain, and I quote, by the middle of August, a consensus had emerged that the status quo was not longer viable. We had concluded that at a minimum, the partnership should be incorporated, i.e. converted into a limited company, so that it could continue as an independent investment banking firm with outside capital. The alternative was a sale of the business to a single buyer. End of quote. How did you come to this conclusion, and why was the partnership structure with unlimited liability not longer practical?
Yeah, I mean, I should have mentioned earlier, I mean, one of the key aspects of the firm was that it was a private partnership. And that is, that was very much seen as part of the identity. And in a way, the partnership was seen as something which was almost separate from the business. I mean, it was like, yes, well, we worry about the business, but actually almost as much time was spent worrying about the partnership and the cohesiveness of the partnership as it was worrying about the underlying business model. But I mean, the reason, and so it was very much sacrosanct in the firm, and that the partnership status was really seen as very, very important to the culture of the firm. So choosing to abandon it was a huge decision for us. And that was really in 2000. And it was a couple of things, really. One is, the 2000, it was all about the dot-com boom. And you won't remember, but it became a lot about equity participation because equity markets were going up at an enormous pace. And people were leaving mainstream investment banks and merchant banks to go and work for startups where you could, put together a business plan, and 6 months later you could IPO it or you could sell it to a private equity firm for millions of dollars and get rich. And so at Cazenove, where the old model was, well, you have to work as a non-partner for 10 years or 15 years, and then you may, if you're lucky, you made a partner. It just didn't seem very attractive against that background. And so we felt that we needed to put a structure in place which enabled us to provide equity to our employees. And also, in those days, again, the perception was it was all about capital. And partnerships find it difficult to raise permanent capital. So it was about that too. Mm. So, but also the competitive landscape had changed. Most of the UK firms had sold out during the late 1990s. So our competition, and we were still a relatively small private partnership, and our competition were no longer sort of UK merchant banks, which it was, Merrill Lynch and Morgan Stanley and Goldman Sachs and these huge investment banks that had gradually muscled in more and more on our domestic market. So that was a thought as well. So anyway, we did look at, this was back in 2001, we did look at selling the business at that point and had some discussions with Merrill Lynch. But in the end, we decided not to do that, but to incorporate. We raised some capital from institutional investors, and we thought, well, we'll build out our business model in a more aggressive way because, we have all this capital. But unfortunately, what happened was that the dot-com bubble burst, and in the wake of that, you had a very long recession, and you had a market background which was really about as bad as it can be for a business like ours, because the stock market, whether it's the UK or the US or the European stock market, started to fall in the summer of 2000, and they kept on falling until 2003, by which time they'd lost half their value. And for a business like ours, which was about equity capital raising, it was about M&A, which is a confidence business, a combination of falling stock markets and recession is about as bad as you can get. So even though we made quite a lot of progress in our advisory business, it was against a shrinking market backdrop. So it was quite a difficult period for us.
Sorry to interrupt, but one quick comment. So did unlimited liability mean that the personal assets of the partners were at stake, and could you therefore engage in more riskier projects because of the incorporation?
I mean, it's true that unlimited liability meant that we all had personal liability for the debts of the firm, but we didn't incorporate to get rid of unlimited liability. The truth is, unlimited liability was not something that ever particularly worried me,
Okay.
because most of our business was agency. Having said that, we would used to do some very large bought deals where if a company wants to place a stake, you buy the shares off them and then sell them into the market. So we did do some very big risk transactions, and David Mayhew was the one who specialized in those. And if one of those had gone wrong, it could have bankrupted the firm. But managing that risk and understanding how to place shares was part of the firm's core business and core strength. So it wasn't really about risk. It was more about broadening out the business model and enabling us to address what we then saw as a weakness, which is our inability to offer equity incentivization to our employees. But then what happened later on was that, it sort of, as the recession in the early 2000s came to an end and business started to pick up in about 2004, the big US investment banks, they all got interested in corporate broking, which was a business that they had basically ignored. They thought it was this slightly strange UK business that they could ignore. But then they realized that actually the corporate broking firms had the strongest relationships with UK corporates. So they all started to become very interested in corporate broking. And so it was obvious to us, David Mayhew and me in particular, because David was the chairman and I was the chief executive, that we were likely to be the object of a lot of interest. So that's really why we started to look in 2004 at what our future was. As I said, the landscape had changed. We felt that we needed more tools in our toolkit in order to stay relevant to our clients, because we acted for smaller companies too, but we acted for big companies. And we were worried that over time we would be squeezed out and become less relevant. So we felt we needed to find somebody who could give us a bigger toolkit so that we could continue to build out our business, albeit as part of a larger institution.
And by doing so, you write in the book that you spoke with all the important and big investment banks and their leadership. So what did you learn in terms of negotiation strategies and also leadership skills during these conversations?
Yeah, I mean, in the summer of 2004, as I said, we were on the receiving end of a lot of interest from investment banks. And so we actually talked to most of the big US banks and one or two of the UK banks. And I talk about this in the book. I mean, David and I went to New York actually it was a bit earlier than that. It was the autumn of 2003. David and I went to New York and we met all the major banks. We talked to, Goldman, Morgan Stanley, Citi, Lehman Brothers, who was still obviously around at that point, and Credit Suisse First Boston, and a number of others. And what was interesting to us was that, you see, essentially, all the US banks, when they started coming into Europe in the late 70s and 80s, they didn't really bother with the UK because the UK had such strong domestic competition. So they tended to overfly the UK and concentrate on their businesses in continental Europe. Well, certainly in the corporate finance business. But that had all changed by the 2000s. And they were starting, they'd gradually, partly by build-ups and partly by acquisition, they'd started to get more into our domestic market. And by then they were quite a force. But as I said, they'd left corporate broking to one side, and they realized if they could get into the corporate broking business, that would actually be the bridge which would enable them to become much, much bigger and more successful in the UK, which was, and actually still is, by far the biggest market for investment banking products in Europe. So it was obvious to David, and all of them basically said the same thing to us in different language, which is we're looking to see how we can do more in the UK. And again, it was obvious that most of them would have an interest in buying us. Goldman Sachs was slightly different. They tended not to make acquisitions in their core advisory businesses, and so they never showed any serious interest in. I think they've always taken the view that if they want to buy somebody, they can always do it. So they didn't show any particular interest, but all the others showed interest of varying degrees of seriousness. And so we talked to them. But for us, we had a couple of problems. One is that putting it bluntly, that they weren't really, the price we were holding out for was a price which was probably not realistic at that point. And one of the problems we had is that when we incorporated in 2001, we sold shares to institutions at £5 a share, which valued the business at around £1 billion. But by 2004, because of the market background that I was talking about, our profits had fallen. So realistically, the firm wasn't worth £1 billion at that point. And yet it was very difficult for us to do a transaction at less than £5 a share, because we didn't want our institutional investors to have lost money. So that put a floor under the price we were prepared to accept. And at that point, that was quite a difficult thing. So from a combination of difficulty over price and also our own misgivings about cultural fit, we ended up not selling the business at that point. And then, so we ended up doing this transaction with JP Morgan that I'm sure we can go on and talk about.
Yeah, and did you also learn some negotiation skills during your conversations with all those leaders in finance? And what else did you learn during this process?
Yeah, I'm not sure I felt I learned any particular negotiating skills, because the truth is we never really got to the point of negotiation with I think what did I learn about it? I mean, I think it was a fascinating learning experience meeting the senior management of all the top Wall Street banks, because it gave you a window on the industry at that particular point in time, which was quite a privileged one. So that was very interesting. They all had different personal styles, but I think it's, what do you learn? You learn to, as we say in English, to read between the lines. So not necessarily to take what someone tells you at face value, but to try to understand what their motivation is, to try to understand what the pressures on them are within their own organization, and how they're then going to have to approach paying £1 billion or whatever the number was going to be for a business like ours in one of their core businesses, and what that meant for the internal dynamics and politics within their firm. So you really had to be constantly thinking, what's in it for them? How are they going to be thinking about us? And how is that likely to influence their behavior? So I think that's probably my takeaway from that process.
Yes, and you mentioned that you were, or the firm were concerned about the cultural fit between Cazenove and the potential buyer. So were you concerned because of Cazenove's special culture that we touched on earlier, or is it more of a general problem when a financial institution gets sold because of the culture, because the culture is so crucial for the success of the business?
Well, it is a general problem in financial institutions, but it was particularly a problem in our minds because, for exactly the reason you mentioned, that we had this very client-centric business model, and yet the people we were talking to were fully committed to the sort of big bank investment banking model. And so trying to see whether there was a way of putting those two things together, which enabled us to continue operating more or less in the way that we had done, which we felt was not just the way we like to do it personally, but it was the way our clients liked it. It was the way our clients saw us, and it was the way it was the thing our clients valued about us. So we wanted to know, can we preserve that whilst at the same time giving ourselves a much broader range of capabilities that we can talk to our clients about? And so with a number of the companies we talked to, I'll give you an example. We had quite a lot of discussions with Barclays, in the Bob Diamond, Barclays Capital era. And, I think culturally, we probably could have put something together. But the reality is Barclays didn't have the product range that really filled the gaps that we needed. So it didn't really have international M&A, it didn't have international equities or any of these kinds of things. because it had got out of all those businesses. So we thought, well, if we do a deal with Barclays, we're potentially in the worst of all worlds because we've lost our independence, and yet we still have the strategic weaknesses, or a number of the strategic weaknesses that we had before. And, so Credit Suisse First Boston at one point under John Mack were very keen to do a deal with us. And again, you looked at it and you thought, well, yes, it kind of gives us the range of product, but Credit Suisse First Boston had a very, it had a tarnished reputation at that time because of a number of scandals. So culturally, it was completely inconsistent with the way we presented ourselves to the market. So we came to the conclusion quite quickly that wouldn't work. We actually had a lot of discussions with Lehman Brothers, which seems inconceivable in hindsight, but we became quite interested in that for a while because they were, at that time, an up-and-coming sort of challenger, if you like. They had an old name, but they'd sort of reinvented themselves as a business. And again, they didn't have the product range that we needed, but we felt that because of their sort of entrepreneurial culture themselves and the fact that there was less overlap, that could be an interesting fit for us. But I mean, the idea didn't really stand up to scrutiny, so we moved on quite quickly from that. And then, as you know, we ended up alighting on JP Morgan, or they approached us, really with this unusual idea that instead of buying us outright, that we could go into a sort of joint venture where essentially they put their UK investment banking business into us in exchange for 50% of our business. And initially we didn't really take it very seriously because it all seemed very complicated. But over a period of time, we came to see the real advantages that could bring us. Well, I mean, I'll talk about the disadvantages, but I mean, the advantages and the sort of rationale for it were that, JP Morgan in 2004, I mean, we think of JP Morgan now as this all-conquering bank. I think it's the largest bank by market capitalization in the world, and it has this reputation for being, very well managed, but it wasn't like that in 2004. It was really a combination of old commercial banks, Chase Manhattan and various others in the US. It had just bought JP Morgan in 2000, and JP Morgan itself was rumored to have been on the brink of bankruptcy in 2000 as a result of excessive risk-taking. I don't know whether that's true, but that was the rumor in 2000. The old JP Morgan I'm talking about, obviously. And they'd bought a business called Fleming's in the UK. So they'd put all this stuff together, but it wasn't a coherent whole. And they'd had a lot of problems with Enron in the US, and no one was really quite sure what the repercussions of that were going to be, both in terms of regulatory fines and also balance sheet write-offs. So they were out of favor. They just bought this big business in Chicago called Bank One, where Jamie Dimon was chief executive. So the Bank One transaction was seen not just as a good strategic deal, but also a masterstroke in bringing Jamie Dimon in, who could take over running the bank. So, and he joined, I think, probably in the spring of 2004. So maybe only a couple of months before they approached us about our joint venture idea. So the reason I'm saying this is that, you look at it now and you think, well, it should have been a no-brainer to go into business with JP Morgan, but it wasn't as simple as that in those days because their UK business was much, much weaker than, for example, Merrill Lynch or Goldman Sachs or Morgan Stanley. So we worried a little bit about, well, what are we actually getting in return for the 50% of our business that we're going to give them? But I felt that even if the actual business at that stage was not that broadly based, they were big enough and important enough that in any future consolidation of the investment banking industry and the banking industry more generally, they would be a kind of winner from that process. So I felt that regardless of the strengths of individual bankers, if they would put all their UK business through us, that had to be a very, very valuable proposition. And so it was complex to negotiate, and it was a complex transaction. I think there were people on both sides who didn't like the idea. I don't think Jamie Dimon much liked the idea. I don't think he's on record as saying he doesn't like joint ventures. But Ian Hannam, who had joined, who was at that stage running equity capital markets in Europe for JP Morgan, and is a force of nature, kind of persuaded the JP Morgan side, particularly Bill Winters, who's now the chief executive of Standard Chartered, but in those days was running the JP Morgan investment bank, persuaded Bill to really promote this joint venture idea in back at headquarters of JP Morgan. And cut a long story short, we got it done.
Robert, you already alluded to that earlier, but what were the big challenges or disadvantages of this joint venture structure?
Well, I mean, there were a number of difficulties, particularly at the outset. We had spent a lot of time negotiating during the summer of 2004 on the management structure of the joint venture. And the way that we put it together was that we had 50-50 ownership, JP Morgan and the Cazenove Holding Company. And we had a balanced board. So we had 3 executive directors, who are all from Cazenove side. So we had David Mayhew as the chairman, I was the chief executive, and Michael Power, who had been our finance director, was the finance director of the joint venture. And then you had 3 representatives from JP Morgan. So you had Bill Winters, who was running the investment bank, Klaus Diedrichs, who was the head of European investment banking, and John Corrie, who was the head of European equities. So those were our 3 JP Morgan representatives. And then we had 4 independent non-executives. And there was a shareholder agreement. So it was very clear, in theory, as to how the business was supposed to be run. And all the negotiation and the presentation of the joint venture was about what we used to call operational independence. So the idea was that we would operate independently, but as part of the JP Morgan family, if you like. So we would introduce JP Morgan people to our clients. We would be able to do more work with our clients. They would be able to bring their expertise to bear so we could do more with our clients. And that was very much how we, on the Cazenove side, approached it. We thought, well, we didn't think that nothing was going to change. We weren't foolish like that. And, we had 50 or 60 of their people come and join us in our building. So we had to integrate them, which presented its own challenges. But essentially, the root of the problems was that we felt that we could operate in a Cazenove way, putting clients' interests first and, being there for the client and all this kind of thing. Whereas the JP Morgan people, and so to us, the attraction of the deal was that we'll carry on in the same way that we've done. We'll have these extra people who will give us more ability to cover more clients and we'll have different expertise. But essentially we will carry on, but we'll have more to do with our clients. Whereas I think the JP Morgan approach, or their mindset going into it, was, well, you have all these amazing clients and you're not doing that much for them. And we've got all these capabilities and products, and we want you to introduce us to all those clients as soon as possible so we can do more with them. Now, it's a subtle difference, but I think essentially, there's a quotation in my book that from one of the JP Morgan people who came over, who said that essentially the attitude of the two sides was completely opposite. So the Cazenove people thought they were going to Cazenoveize all these JP Morgan people, and the JP Morgan people thought they were going to JP Morganize all these Cazenove people. So you can imagine if you go into it on that basis, it's going to lead to quite a lot of tension, and it did. And I think also a lot of the people who covered, in fact, the majority of the people who covered the UK market for JP Morgan were actually British. They weren't Americans. And a lot of them had worked for Fleming's, which was a business that JP Morgan had taken over in 2000. And so they thought, I think, well, they're Brits, so it'll all be fine because they're all the same kind of people. But actually, they had been used to operating in a completely different environment with a completely different incentive structure from us. So, and in fact, they also suffered from this sort of snobbishness that existed in the UK, where merchant banks like Fleming's tended to look down on brokers like Cazenove. And so there was a little bit of that. They sort of thought we were kind of lazy brokers, who got into the office late and went out for long lunches and weren't capable of operating in the kind of environment that we were now represented. And we sort of thought that they were slightly overblown second-tier investment bankers who exaggerated the strength of their relationships. So again, you can see with those kinds of attitudes, you were going to get a lot of tension, and it resolved itself reasonably quickly, and it was helped by the fact that the actual business, the joint venture, was very successful from day one, but it caused a lot of tension in the boardroom because the discontent on the JP Morgan side bubbled up to the three JP Morgan representatives, who spent a lot of time sort of saying to me, well, it's all going wrong, and our people aren't happy, and we're losing people, and it's all going to be a disaster. And I kept saying, no, it's not, it's fine, let it settle down, it's perfectly natural, it'll all be fine. And that wasn't a message that they really wanted to hear. So it caused a lot of friction in the boardroom too, which I talk about quite a lot in the book.
And in hindsight, can you think of any better partner for this joint venture, or was it the right decision to do this joint venture with JP Morgan?
Oh, I think absolutely no question, JP Morgan were the right partner, and for all kinds of reasons. I mean, they're now the leading investment banking franchise globally. Became much stronger, obviously, in the wake of the financial crisis in 2008. And the business fit was very, very good. I mean, I think there were things we could have done to mitigate the cultural and people tensions at the outset. And there were personal relationships in the boardroom that were difficult, and I think that was just down to individual personalities. But I think, so yes, we could have prepared people better. We could have made sure there was a greater alignment in terms of our objectives. But I think there was always going to be difficulty around the integration of the two firms. And, that's been seen in most of these investment banking type mergers. And in fact, although living through it, it was very difficult. It was very difficult for me because the chief executive is always the lightning rod for all this discontent. And fairly soon as well, after a year or two, JP Morgan essentially were trying to get control of the joint venture because they found it very frustrating because they didn't control the joint venture and they didn't manage it because it was managed by Cazenove people. And yet they sort of felt that they should be in charge. And so the only way they could do it, because of the contractual arrangements we had and the governance arrangements we had, was by trying to get rid of me and get their own person in, which is what they tried to do. I mean, it didn't work, but it just made the whole process quite bruising and unpleasant for me personally. But curiously enough, even despite that, I never doubted that the deal was the right one for us. And I think there's no question that it was a great success business-wise, and it was a great success financially too, because when they eventually bought the joint venture out in 2010, if you add up all the components, what they paid, what our 50% of the joint venture was worth, the dividends we'd received, we still owned our high net worth business because that wasn't part of the joint venture. I mean, the whole thing was valued at close to £2 billion, which for a little UK broker we thought was not a bad number.
Yes, that's impressive. And you mentioned Fleming's and the distinction between merchant banks and corporate brokers in the UK. So did you ever thought of turning Cazenove into some kind of independent advisor like Lazar or Rothschild? Or was this never an option because M&A was not Cazenove's core business, and at least not in the beginning?
No, I think that that's exactly right. I mean, the idea that we could have turned ourselves into a Lazard or a Rothschild or even a Greenhill or a Centerview. I mean, the reality, we had a reasonable M&A business of which I became quite proud. But the reality is our DNA was equity capital markets. And in order to be in equity capital markets, you have to be in the equity markets, which means you have to have cash equities, which means you've got to have analysts and salespeople and traders and technology and all these things, which are very, very expensive. And if your only business is cash equities as opposed to derivatives and risk and proprietary trading, to the extent that's still allowed, then that's it's a very cyclical business, which is very expensive to be in. So I think the idea we could have turned ourselves into a sort of global M&A boutique is just not realistic. I think what we could have done, and definitely should have done, is built up our asset management business much more aggressively. And again, it goes back to what I was saying about perceptions in firms. I mean, we saw ourselves as a stockbroker going back, and particularly a corporate stockbroker. And so our private client, as we used to call it, our private client business, wasn't a department. It was just a desk. You had a handful of partners dealing with private clients and broking stocks and shares for them. And of course, in the meantime, the whole investment management industry was becoming much more sophisticated, and people were moving away from a commission-based business into a fee-based business, which we sort of did, but we never really did it in a wholehearted way. So when I took over as chief executive in 2001, our private client business was, I think, about 12 billion euros under management. But I mean, it was almost loss-making. And to run a private client, any investment management business at a loss, I mean, it's just inconceivable because it's inherently such a profitable business. So essentially we had to, we put some new management in and got some, additional fund management teams and increased the range of products. And that was quite successful. And we ended up selling the investment management business to Schroders for something like 500 million pounds, which, and that was, I can't remember when we did that, 2014 or something. But I mean, if you'd told us in 2000 that we would have sold that business for 500 million pounds, we would have thought you were crazy. But the reality is it should have been a multi-billion pound business if it had been really invested in properly. And that's what you've seen in a lot of the old merchant banks, including Schroders itself. So Schroders basically sold its investment banking business to Citigroup and turned itself into a pure fund manager. So I think if I look at the single biggest mistake we made was not investing really heavily in our asset management business.
And as CEO, you played a key role in Cazenove's change management. So what are the most important lessons learned, especially through tough decisions, also such as closing overseas offices or cutting staff?
Yeah, I mean, I think there are a couple of things that I took away from that. One is, I mean, you've got to be prepared to take action. And I know that sounds a bit obvious, but many people, particularly in these kind of people-related businesses, they don't really like taking radical action because it's difficult and it gets in the way of personal relationships within the firm, and it's disruptive and it's frightening because you think, oh my goodness, what's going to happen if I get it wrong? And it becomes, high profile. It gets in the papers for all the wrong reasons. But you have to be prepared to take action when you see that it needs to be done. And that happened, with us, whether it was, reducing our international network. And again, I mean, we'd never, as a firm, we'd never made anybody redundant. We'd never closed an operation. And even if, things were allowed to lose money for years and years and years because nobody wanted to grasp the nettle. So I think if I give myself credit for anything, it's that I was actually prepared to tackle these problems rather than just complain about them, which is what a lot of people like to do. I think the other thing I learned was you can actually shake businesses up much more radically than you think you can. Because one of the things people do is they say, oh, if you do this, then everybody will leave, and then there'll be a death spiral, and the firm will, collapse. And it's just not true. You can actually shake businesses up really quite radically, and people sort of pick themselves up, dust themselves off, and they just get on with their jobs. So I think that business of not being, I mean, obviously you've got to have good judgment, so you make the right decisions and take the right actions, but you have to be prepared to actually do things rather than just talk about doing things. I think that's probably the most important lesson that I learned from that period.
Yeah, and you're currently in a leadership position yourself, and you had many encounters with the most visionary and prominent leaders in the financial sector, such as Jamie Dimon, Bob Greenhill, or Stephen Schwarzman. According to your observations, are there any skills or traits that successful leaders in finance share or have in common?
Yeah, I mean, I think, again, it slightly depends on the business. I mean, they tend to be very smart. But I mean, curiously, my next book project, which I thought would be interesting, is what I'm in the process of doing is putting together a book which says what is it that differentiates the handful of real superstars in the investment banking business from the many, many hundreds or even thousands of competent investment bankers that there are in the world who will do a very good job for you, but will never get to that next stage. And I'm building this around a series of interviews with leading investment banks, and I'm hoping to publish this when I get around to writing it up, which I think would be hopefully a bit interesting the kind of people who are members of your club to address this particular question. And actually, the book or the perspective book is aimed more really specifically at the M&A and advisory businesses, and talks about the characteristics that you need, what differentiates an Andrea Orsell or a Simon Roby from the rest of these people. And it's a combination of confidence, persistence. I hate to use the old cliche, but they tend to have a real passion for the business. They do it because they love it. They don't do it just because they think they can make money or raise their personal profile. I think you have to have a real interest and affinity for the business to do really, really well at it. You've got to be able to step back and look at the bigger picture. And one of the chapters in my next book is going to be entitled "Hard Work is Overrated." And what I mean by that is, it's quite important to understand what I mean by that, is that a lot of the time when people give advice to young people looking to enter the financial markets, they'll say, they talk about how important it is to work hard. And, so you got to be prepared to do the photocopying or go and get the coffee or whatever it is. And on one level, of course, that's true, but I just don't think it's very helpful advice, because it's just like a basic requirement. It's just like saying you got to turn up every day. Everybody knows you got to work hard, but the guys who and girls who get to the top are not necessarily the ones who work the hardest. They may work very hard, but it's also people who have time to step back, think about the businesses they work for, think about their clients' businesses in a sort of holistic way, have enough sort of personal depth to be able to cultivate relationships with senior people. And you don't get those qualities by sitting at your desk grinding away at spreadsheets for 15 hours a day. That's not to say you don't need to do all those things, that those things aren't important, but you've got to be constantly thinking ahead about, well, what's the bigger picture here? Because those are the people, in my opinion, who really differentiate themselves in the kind of businesses that we're talking about.
Yes, interesting observations. And you spent most of your professional life in London, but you have also worked in New York. So are there big differences in terms of corporate culture and the way the business is run and organized?
Well, I was there in the late 80s, and it was culturally very different in those days. I mean, I was trying to do... A lot of British firms were trying to make acquisitions in the US at that stage, and I was trying to sort of intermediate in that process with mixed success. But I had a very good seat at the table in terms of observing what was going on, and that very late 80s period was fascinating, because you had the 87 stock market crash, which everyone thought at the time was a disaster, but in fact it sparked a huge M&A boom, which culminated in sort of 1991 with the whole Barbarians at the Gate, RJR Nabisco takeover with KKR. So there was a huge amount of stuff there. So watching the American firms and how they approached that business and trying to think whether we could take some of those lessons and apply them to our own business in the UK was very important. And culturally, it was completely different, because in the UK in the late 80s, as I said, it was all about merchant banks and brokers and advisory and all that sort of stuff, whereas the US, they were already onto a much bigger investment banking model. But if you fast forward to today, I mean, the reality is that the whole investment banking culture has become Americanized. I mean, even if you went to Deutsche Bank, you would find effectively an Americanized culture there, even though there probably aren't many Americans, because that's the way the whole industry has gone for the big banks. And in a way, the industry has fragmented into large universal global investment banks who do everything they can for their clients, and a satellite of sort of smaller advisory firms around them, some of which by in the way I think, are actually quite big businesses now. Several $billion of market cap. And they provide a different service around the edge. So that's really the way the industry has gone. And I think, you can sort of feel sad about the fact that it's not the way it used to be. But the reality is, if it's gone that way, then that's because that's how the clients like it. I mean, large clients have a lot of internal resource. They tend to view big investment banks as counterparties rather than advisors. And if they want advice, they tend to get it from one of the smaller boutiques, if you like, that specialize in that area. I mean, even calling them boutiques now is a bit of a misnomer, but that's an oversimplification. But that's essentially the way the industry has shaken out. And then you've got a lot of businesses around the edge that specialize in all kinds of niches in the financial services business. So the business that I chair at the moment, Marex, is a business. We went public in the US in April. We got a market cap of around $2.5 billion, and we do clearing. So we connect clients, institutional clients, predominantly to exchanges in the derivatives and futures markets, and we margin for them, and we lend the money to do that to some degree, and we market make in commodities, and we have a business in financial securities too, and structured products. So it's all these little niches. And a very profitable business, but slightly out of the mainstream of what the big investment banks do. And there's lots of other businesses that look a bit like us, or have slightly different business mixes. So the landscape is much more varied than it was when I started out in the 80s.
Now we nearly reached the end of our podcast, but I have two further questions I want to ask you. Because you are one of the few professionals that can give us the big picture. So based on your observations, how did the city of London as a financial center evolve from the 80s, when you started your career, to the Big Bang, to the dot-com bubble, the Brexit, up to this day?
Yeah, well, I mean, I think we've touched on quite a lot of the themes already, but essentially you went from in the mid-80s when I joined the Cazenove, you went from a clubby, male-dominated closed shop that it was very difficult for other people to break into, through the Big Bang reforms of the late 80s, where you had external capital allowed into the City of London, and the entry of a lot of banks trying to form large financial supermarkets. So that was a huge change in the way that the city operated, and paved the way for London to become a major international financial services centre that it still remains today, despite some of its difficulties in the IPO market. You then had what they used to call the second barrel of Big Bang, which was essentially in the 90s, where some of the larger conglomerates which had been formed by UK firms, one by one, they either went out of business or they sold out because they didn't have the capital, they didn't have the skills, they didn't have the stamina, the staying power to compete in a business like investment banking. And so really from the late 90s onwards, you had an increasing domination of the business by Americans and one or two Europeans. I suppose Deutsche Bank at that point would have been seen as a contender, perhaps less so today. And so that really paved the way for the city that you have today, which, as I was saying, is an environment where the business culture has become completely Americanized, and the dominant players are pretty much all Americans. But as I was indicating a while ago, that means that but the ecosystem is so much bigger and more varied that there's plenty of room for other firms to operate in a way that they can be very successful and actually at scale. So along the way, I think something's been lost in terms of the partnership culture, the partnership spirit, the sort of camaraderie of the old days. But again, one shouldn't be too sentimental about it, because it was an environment that excluded women, it excluded people of color, in many respects, it excluded people who came from backgrounds which were less privileged. And now it's much, much more meritocratic. I mean, if you just can tell that by walking around the city now. The whole look and feel of it is completely different from how it would have been even 20 years ago. So I kind of feel that is a net positive. And so I don't spend a lot of time dwelling on, I mean, having said that, I've just written a book about the past, but I mean, and that was something I wanted to do. I don't spend a lot of time dwelling on the past and in the city and feeling that that's something that we should try to recreate. I think we should embrace where we are today. And, if there are lessons to be learned about how client service or how to deal with your colleagues or culture, then we should try to learn those lessons. But other than that, we should embrace the city as it is today and try to make the best of it.
Yes, of course. And our podcast is mainly a student podcast because it's podcast from a student initiative. A lot of students listen to our podcast. So would you still recommend graduates to start their career in a financial institution nowadays? And if so, would you recommend an independent advisor such as Lazar or Rothschild, or a large investment bank like Morgan Stanley, JP Morgan, Bank of America, and which division within these organizations seems the most appealing and future-proof to you?
Yeah, I mean, I think I certainly wouldn't discourage anyone from seeking a career in financial services. I think you have to do it. You have to go into it with your eyes open. You have to understand you're going into a Darwinian business where you have to work very long hours. You have to have a huge amount of commitment to the firm. Despite all the sort of recent talk about it, the whole business of work-life balance is not what you would get in a lot of other professions. But equally, there are rewards, not just financial rewards, but you get to work with, by and large, you're working with very smart, motivated people. You get to meet some very interesting people and interact with interesting people on the client side at quite a young age. So I think those are, again, positives which aren't always available in other walks of life. I think, in terms of it's I hesitate to give people advice because it's such a completely different environment. I mean, I was a classic baby boomer, and my generation benefited from the fact that we could pick and choose up to a point what jobs we took. I mean, it was just like a completely different planet from how it is today when I talk to young people, and so the fact that you have to be persistent in terms of your job search and you have to mine whatever contacts you've got, try to get internships. I mean, to be honest, you would know more about that than I would. But I think I think as a general point, if you have a choice, you're best off always going into a big firm that can give you a broad range of experience when you're young. And I think by all means specialize, but I think even if it's only 2 or 3 or 4 years after you graduate, it's worth getting a good general grounding first. And the best place to get that is in one of the big banks. But I mean, there's also the professions. I mean, there are also the accountants. If you're inclined that way, I think accountancy is still a very good general financial training. Law, I did law, but law I think probably less so than it used to be. And as far as your question about, I think if you went into one of the big M&O boutiques, like as you said, like Moelis or Lazard or whatever, I think you'd probably get a very good training, but it would be a training in M&A, and I'm not sure how well it would equip you for other things. And then, of course, there's the whole markets and trading side of the business, which is a completely different thing, requires a completely different skill set. And, if that's your bent, if you have very good mathematical skills, very good quantitative skills, I mean, then you can do very well in those businesses at quite a young age. So I think that, in the meantime, try to learn as much as you can. I think you're unlikely to succeed in these businesses unless you have a genuine interest in them. So make sure you're up on world affairs. Make sure you're up on, read Bloomberg, read the Financial Times. Just be aware of what's going on. I think that's, and if you find that you read those things and then you're interested in them, then there's a good chance that financial services is for you. If you read those things and find them boring, then you might want to ask yourself whether you're looking at the right profession for you.
Yes, and I have one final question left. So you just said you hesitate to give advice, but what is the best advice you've ever received in your professional career, and what advice would you like to give our listeners along their way, many of whom are still at the beginning of their careers?
Well, I'll tell you the best advice I was ever. It'll sound very a bit stupid, really, but the best advice I was ever given was by the father of a friend of mine, and this is when I was I tell you when it was. It was when I was. I was a qualified solicitor at Allen Overy, and I was agonizing over whether to accept a job offer from Cazenove. I was age 25, and I was trying to figure out what to do and asking people and what should I do. And anyway, the father of a friend of mine who was quite a senior person in the financial services industry in London said to me, he said, look, at the end of the day, you've just got to use your own judgment. And you say, okay, well, big deal. But actually, it doesn't sound very profound, but it really is. And I tell you why, because often when you're starting out and you're trying to figure out what to do with your career or to accept a particular offer or to move within your firm between departments, or you might get offered a posting overseas or whatever, you tend to think that there's a right answer, and that if you analyze it enough and if you ask enough people, you'll be guided to that right answer. And what this piece of advice told me at the time was that actually life isn't really like that. You have to be, obviously you've got to do your homework and you've got to do your research, but at the same time, there comes a point where you can't analyze your way to a conclusion. You just have to hold your nose and you have to jump. I felt that stayed with me all these years, and I think it's a very valuable thing for young people in particular to be aware of, because it gives you the confidence to think, well, ultimately, I've got to make this decision myself. Nobody else can make it for me.
Yes, thank you, Robert. I think that's really great advice. And if we made you curious, take a look at Robert's book, Blue Blood, Cazenove in the Age of Global Banking, and also his new book, which is probably available at some point in the future. So stay tuned, and thanks again to you, Robert. We very much appreciate it.
No, not at all. Thank you for having me. I enjoyed it. Very good.